Welcome to part 2 of the How to Calculate PIP series. If you are new to this channel, Magna FX Institute is a trading channel that helps traders conquer their mind in order to conquer their market. A lot of traders have a misconception that trading is all about strategy and forget about their psychology, therefore making errors that affect them in the long term. If you are interested in everything Forex, make sure to hit the subscribe button and turn on the notification icon. Let's get into the video. In part 1 of the series, I explained how to calculate pips on the different pairs. If you haven't watched the video, pause this video and watch part 1 because part 2 is a continuation. In part 2, I'm going to show you how to convert pips to money. Let's bring out the calculator. Okay, let's say you open a lot size of 0.10. I'm assuming most of you know how to open a lot size. If you don't know, let me know in the description below. Let's say you open a lot size of 0.10 and your stop loss is 30 pips away from your entry price. So I've already taught you how to calculate pips. You can go ahead and watch the previous video to know how to calculate pips. You move one decimal point. So this decimal point removes one step to the right, meaning this will change to 0, 1. So it will change to 0, 1.0. So the 0 automatically goes away because this calculator rounds off the figures. So it's going to be 1.0, meaning per pip it's going to cost you $1. So it's going to be $1 per pip. So if it moves one pip in your direction or one pip against your direction, it's going to be giving you or taking away $1. So you multiply this number, this decimal value, after moving the decimal point by the number of pips. So in this case, we have 30 pips. So meaning it's $30. So if your stop loss is 30 pips and you open a lot size of 0.10, $30 will be taken away from your account. Then let's say your take profit is $100, meaning your profit will be $100 straightforward. Let's go to the other example. Let's say you opened a lot size of 1.00. So you follow the same procedure. You move this decimal point one step to the right, so it's going to become 10.0. So this means per pip it will cost you $10. So it's going to be $10 per pip. If it moves one pip in your direction, one pip against your direction, $10 is going to be added or taken away. So if your stop loss is 30 pips away from your entry, so it's going to be 10 by 30, 10 by 30, which is giving us 300. So you'll be losing $300. And if your take profit is 100 pips, you multiply it by the same $10 per pip, giving you $1,000. So you're losing $300 to gain $1,000, which is a pretty good risk to reward in the long run. So you see why risk to reward, you see why risk management is important. You lose less to earn more. So if you have 2 losing streaks in a row, then you have 2 winning streaks in a row with the same risk management as the one that I have given you, where you lose $300 and you gain $1,000, you'll find that you're profitable. not the other way around where your setups are not clear and you're just entering trades out of emotion. That way you can't track your trades properly and you can't track your losses, and your losses will be difficult to recover in the long run. So what determines the amount of money you earn or lose? Of course, your lot size. Your lot size is what determines the amount of money you earn or lose in a trade. So always make sure before entering the trade, you open the right lot size so that when the trade goes against your direction, you are able to recover from the trade. So in the last example, in this example, let's say you open a lot size of 0.15. So what do? So you move the decimal point one step to the right. So when we move it one step to the right, it's going to be 0, 1, 0 automatically goes away, 0.5. So it's going to be $1.05 per pip. Hope you're following me. So what's next? You multiply. So you multiply by the number of pips you are losing or gaining. So in this case, our stop loss is 30 pips away from the entry. So 1.5 times 30, giving us 45. So we'll be losing $45 on the trade. So let's look at our take profit. Our take profit in this example is $100. So 1.5 times 100, that will give us 150. So we are losing $45 to gain 100. So we're losing $45 to gain $150, which is a pretty good risk to reward again. Which is a pretty good risk to reward again. So you see why keeping your risk low and maintaining good risk is very important. In the long run, you will be able to recover the money that you are losing from these losing trade, from the consistent losing trades you will be having. Okay, that's it for this video. Thank you for watching this far. As a token of appreciation, I'm sharing our Telegram channel with you, where you'll find a sample of a trading plan and you can make yours from it. Head over to our Instagram channel at Magna FX Institute, where you'll find the link in the bio. Thank you.